There are a number of other important risk management factors that a pair trader must constantly consider in addition to position size. In this next section, we will discuss time stops, dollars-based stop losses, news events, sector characteristics, and fundamentals. With our Pair Trade Finder trading system, by default, there is a time-based stop of 100 days built in, meaning regardless of profit or loss or distance from the mean, the system will generate an exit signal once the position has been open for 100 days. This limit is to prevent us from keeping losing positions open for a long time, allowing them to go further against us and tying up capital that could be used elsewhere. You can tweak these parameters yourself in Pair Trade Finder and backtest them to see what the results are like. Generally speaking, reducing the time stop to less than 100 days reduces overall profitability. However, it can help reducing the size of losses and average days in a trade. As with most trading systems, using a fixed price or dollar stop reduces performance drastically, and it's for this reason PTF doesn't have built-in price or dollar-based stops that you typically hear about in technical analysis books and courses. We've tested using dollar and price stops in pair trading, and it reduces profitability greatly. This is because most pair trades go against you initially before reverting to the mean. Sometimes this scenario allows an even better opportunity to scale into your trade and lower your cost average, whereas typical literature out there says this is when you should stop out of a trade. Whilst that sounds nice on paper to keep your losses to a minimum with a stop, it's not how the market works in reality. Traditional stop losses assume prices move straight up and down in a nice, neat pattern, but in reality, market prices do a lot more. They trend, go sideways, gap, spike, all in a quite random, chaotic fashion. They rarely rise or fall in the linear fashion that we would like. It's for this reason you have to give prices plenty of wiggle room to move about before reverting back to the mean. However, if you've been stuck in a pair trade for longer than 30 days, you have to consider the opportunity cost of having margin tied up in a losing trade rather than redeploying into a new, potentially profitable trade. That's why you need to define your time-based stop, the maximum amount of time you'll keep a trade open. For some pair traders, it's 20 days. For others, it's 60 days. We encourage you to tweak Pair Trade Finder to your liking in regard to this limit. Some pair traders also do have a hard dollar stop in place, but not your typical 2% or 3% that one often reads about. For example, on a $20,000 account using 20% stock exposure, some traders might have a hard stop of 20% based on 2 legs at $4,000 for $8,000 total exposure. Meaning, if an open pair trade was showing a $1,600 loss, 8,020%, it would be closed. As you can see, it's a very wide stop loss that may only get hit once or twice a year, but is in place to draw the line in the sand in regards to big losses. Other than that, the majority of your trades shouldn't be stopped out. Whether at a profit or a loss, most of your trades should be exited once the pair reverts back to the mean. That's why it's important you only trade pairs where both stocks in the pair are as similar as possible, because then they are more likely to revert back to the mean. Another point to consider is what to do when bad news comes out on a stock you hold a position in. Some pair traders will immediately close a pair trade if unexpected stock price sensitive news comes out on a stock on which they have an open position. Others will make a discretionary decision based on the news itself. If the news is positive for your position, you may wish to hold as per usual for an exit signal. Examples of price-sensitive news are operational updates from the company, upgrades or downgrades from brokerage firms, new litigation, gained or lost contracts, or anything else that could affect the company's profits. Another point to consider when designing your risk management plan is what sectors you will and won't trade. Some pair traders won't touch any financial or resource stocks, while others may only trade stocks in a particular sector. When trading sectors like mining, resources, technology, and biotechnology, you should have smaller position sizes. Not only are these sectors more volatile, warranting a smaller exposure, but they also have more long-tail risk, meaning they're more vulnerable to unforeseen news announcements that can have a large impact on the stock price. The goal in pair trading is to get to intimately know the stocks you trade, so specializing in several sectors can help you achieve this knowledge. Because good pair trading isn't just about blindly following trading signals. The best pair traders follow the market and their stocks closely, knowing which stocks are in play and which stocks are vulnerable to certain events happening. You can also study the fundamentals of your stocks, knowing whether a stock could be undervalued and potentially attracting large value buyers. Combining both fundamentals and technicals in pair trading leads to powerful results. The more factors in your favor adds to a higher probability of a successful pair trade. Generally speaking, the longer your trades are open, the more fundamentals come into play, especially for those who tweak Pair Trade Finder to trade on a multi-month time frame. However, for average trade lengths of less than 30 days, it's more about the technicals and news. Eventually, after trading for a while, you'll naturally develop your own system and parameters, because what works for one person may not work for another. So sometimes it's a case of trial and error to find your sweet spot. To sum up this lecture, you need to minimize your risk in pair trading by keeping to strict exposure limits to what percentage of your account you'll have invested per stock pair and in any one stock at any one time and for how long. This amount also needs to account for underlying volatility of the stocks and sector. Always remember, good trading is all about making lots of small trades with which you have a statistical edge.